Today's lesson will be Chapter 23, Problem 4B. I'm sharing with you my Excel spreadsheet for Chapter 23, Problem 4B. What we're going to be doing today is a factory overhead cost variance report. And we're going to be the Feeling Better Medical Incorporated Company, who is a manufacturer of disposable medical supplies. And they prepared the following factory overhead cost budget for the assembly department for October of the current year. And they tell you that the company is expected to operate the department at 100% of normal capacity, which is 30,000 hours. What normal capacity is what they think that they'll be operating at. And it's going to take them 30,000 direct labor hours to be able to operate at 100% capacity. They've given you the following variable cost as well as the fixed cost for the factory overhead. And this budget is based on 100% capacity, which is the 30,000 hours. Now notice in their additional information, they tell you that during October, the department actually operated at 28,500 hours. So the factory overhead costs that were incurred these are the actual costs for that period of time of $234,000 for indirect factory wages. Power and light was $178,500. Indirect materials was $50,600. Supervisor salaries was $126,000. Depreciation of plant and equipment was $70,000, and insurance and property taxes was $44,000. Those are your actual costs that happened. What they want you to do is they want you to prepare a factory overhead cost variance report for October. And it says to be useful for cost control, the budgeted amount should be based on 28,500 hours. So these are budgeted amounts based on 30,000 hours or 100% capacity. That's not what they want you to use for the budget. They want you to use the budget based on 28,500 hours. So I'm going to show you how you need to calculate the percent that you actually operated at so that we can convert this 100% operating hours to the actual operating percent capacity that we actually did during this period of time. So they have given you the productive capacity for the month. And that productive capacity for the month is that 100% normal capacity is 30,000 hours. The actual amount that we produced was 28,500 hours. Excuse me. So what's happened here is we are operating below 100% capacity. And what you'll need to do is find the percent that you're operating below capacity. And basically what you do is you put in the actual production hours for the month and divide it by what you could have operated at if you were operating at full capacity, which is 100% or 30,000 hours. So I've created that calculation for you here. I simply divided 28,500 hours by 30,000 hours, and that gave me 95% is what we're operating at for this period of time. So that means we operated below capacity. We operated below 100%. So I can already tell you that this is going to be an overall unfavorable, overall favorable variance because the actual production hours were less than 100%. And so technically That's not true there. It is an unfavorable variance, and the reason for that is because we didn't make 100% capacity. We operated at less capacity, so it has to be unfavorable. Okay, now I put this notation in here, and I'm going to put it in bold now. Let's see if I can get that to bold up there. There we go. Because they don't give you this information, but I wanted you to note how we calculated this 95% and why we did that. Since the company operated at 28,500 hours instead of 30,000 hours that they originally budgeted for, the company operated at 95% capacity, which is below capacity. Multiply the given expected budgeted amounts by 95%. That's how they're getting this budgeted amount that I have figured right here for you. Notice I put on here that it's the budget at 28,500 hours. This is what our budgeted amount would have been. But what we have to do is we have to convert this 100% capacity to 95%. So basically what you're doing is you're multiplying your variable cost only by 95% of this 100% amount here, and that will give you the budgeted hours. So in other words, for indirect factory wages, the indirect factory wages at 100% capacity is 247,500. If you multiply it by 95%, that will give you the budgeted amount at the actual hours that you used. And so this is the budgeted amount that we're going to compare with the actual amount that was given to you right here. These are actual figures right here. And so my actual indirect wages was 234,000 that I plugged here. And then I had to determine the budgeted amount at 28,500 hours. And again, I took the 100% budgeted amount, multiplied it by 95%, and that gave me the budgeted amount at 28,500 hours. And then what you do is you compare your actual to your budgeted amount. Since your actual is less than your budgeted amount, you had a favorable variance for your indirect factory wages. The next type of variable expense is power and light. And the actual amount for power and light was given. So I just plugged that amount in. I have to determine this amount, and to determine it, I'm going to take my budgeted amount of power and light at 100% capacity, which is 189,000. I'm going to multiply it by 95%, and that will give me my budgeted amount for my power and light. So you can see you can't develop this budget unless you know what this percentage is. So on your homework problem, take your actual production and divide it by your productive capacity, which is always 100% capacity. And that will give you the percent that you operate at. Now, sometimes your actual production will be more than your productive capacity for the month. If that's the case, you can operate above 100% capacity, or you can operate below 100% capacity as we did here. So once you have your budgeted amount at 28,500 hours, you compare your actual with your budgeted. And again, this time it's a favorable amount. And notice favorable amounts, you should have a negative in front of those. So don't forget to put your negative amounts in for any favorable variance in Cengage. If you don't, they'll count it wrong. The indirect materials, the actual amount of indirect materials was given right here. I just plugged it in. And then you have to determine the budgeted amount for indirect materials at 28,500 hours. And so what I did is I took the budgeted amount at 100%, indirect materials, multiply that by 95%, and that will give you the 49,875. This time my actual amount is more than my budgeted amount, so I have an unfavorable variance as the difference there. And then what they did is they just added up their variable cost. And then what they did is they put in their fixed cost. And the fixed cost, you'll notice, will not vary with the level of production. But the fixed cost could change if, if, for example, you bought a new piece of equipment, your depreciation could be more than this amount. Or if you had an increase in your supervisor's salaries, it could be more than that amount. But in this case, all of our fixed costs are the same as what we budgeted for. And so we had, for fixed costs, we had supervisor salaries, 126,000, that was the actual amount. I just plugged that in. For depreciation, plant and equipment, the actual amount was 70,000, I put that in there. For insurance and property taxes, the actual amount is 44,000. So these are the actual amounts they are given. The budgeted amounts for fixed cost, it doesn't matter whether you operate at 95% capacity or 110% capacity. The fixed costs are going to be whatever you budgeted, no matter what. They don't change with the activity level. So the fixed costs remain the same. So you can see here the budgeted amount was 126,000. You're just going to plug that in there. 70,000 was for depreciation, and insurance was 44,000. All of those are just plugged in amounts there. The fixed actual overhead cost equal the budgeted overhead cost. When you add these together, they're the same amounts. And then your total factory overhead cost will be your actual variable factory overhead cost plus your fixed factory overhead cost that was actual, and that'll give you this 703,100. To get the 704,550, you would add your budgeted variable factory overhead cost at 95% to the fixed costs that were budgeted, and that gives you 704,550. Now, right here, they're asking you for the total controllable variances that were unfavorable. So you just add this column up, and the total controllable variances that were favorable, you combine these two together, and that gives you 2,175 that's favorable, which you combine with your unfavorable variance to get an overall net amount of the controllable variance at 1,450. So this is your net amount right here of your controllable variance. These two were added together here to get that. So the only difference between this problem's controllable variance and the problem that we did for problem 3B, 23-3B, is that they've broken these down, the variable costs down into separate amounts. So we just broke them out. There's another way that we could have calculated this. We could have just compared the actual amount of the variable factory overhead, the total amount of variable factory overhead, actual, with what was budgeted at 95% of capacity. These two compared, or these two, if you subtract them, will give you this very same thing here. So there's really another way that you could have looked at this information and presented it. What they just chose to do was to separate out their variable expenses, so you could chase each one of these variable expenses back to see how you could fix that in the future. These are controllable variances, so management has some control over those. They would just have to go back to maybe HR for the wages, power and light, might just go to the production to see if why this was favorable, the production department. And your indirect materials, you probably go to the production department for that too. So remember, the whole reason for us doing the variances is that we want to be able to direct our operations better in the future. Now this part right here is the second type of variance that we're going to be looking at, which is going to be the volume variance. And so what they did is they kind of have this title funny here, but this is the volume variance. I tried to put it just the way Cengage would put it in your textbook so you wouldn't get confused. But I think if they just called this the volume variance, it would have been better and left this unfavorable stuff off. But it is unfavorable because we operated below capacity. And you'll figure that out once you determine the total amount of the unfavorable variance that's right here. And instead of breaking it down like I did in an earlier problem, which you could use that same formula in the earlier problem, it works. I went ahead and put the idle hours at the standard rate, and then you multiply it by the fixed factory overhead rate. The idle hours at the standard rate is found in cell B57, I believe it is. So let me scroll on down here. Yeah, I've showed you how they've calculated that here. To find the idle hours, we compare the productive capacity for the month at 100% capacity. This was the given 30,000 hours. That was 100% capacity. And we subtract out what we actually operated at, which was the 95% capacity. The difference in those hours, or what they are referring to here, is idle hours. The idle hours are going to be multiplied by the standard fixed factory overhead rate. And they didn't give you that. So you have to figure it. And this is the calculations for figuring the fixed factory overhead rate. You're going to take the budgeted fixed overhead at normal capacity, which was 240,000. So you could get that two places. The budgeted amount would be right here, 240,000, or you could get it from up above. This right here is 240,000 too. So the budgeted amount was 240,000 at normal capacity, just means it's 100% capacity. And we're going to divide this by the normal productive capacity hours. So that was the 100% hours here, which is 30,000. If you divide 30,000 into $240,000, that'll give you a fixed factory overhead rate of $8. So $8 times the idle hours of 1,500 is how they come up with this $12,000 unfavorable variance. And again, it's unfavorable because we operate below capacity. If we had operated at 110%, then that would be above capacity, and this would have changed to a favorable amount here. So this is your unfavorable volume variance for this period, that when you combine that with your net controllable variance of 1,450, that was a favorable amount, this combined with this will give you an unfavorable amount for the overall total factory overhead variance. And that's all they wanted you to look at. And you might see this extra 1,450 down here. This is where I was just showing you a while ago, that to find that 1,450, you could subtract these two and it'll give you this amount. So you don't need this here. This shouldn't be here at all, but I just put it in there just to prove that right there. All right, so I hope I haven't confused you on anything here, but it's important that you know how to calculate your factory overhead variances. And again, there are two of them. There's the volume variance and there's the controllable variance. And Make sure you know how to do those. And so I want to stop here, and we'll see you again next time. Bye-bye.